So firstly, of course, to say thank you to everyone for taking the time out of the middle of your week to be here for this. Before we do start, I just wanted to highlight the panel that we do have, because it really is a distinguished panel of experts. We have Sergio, Malin, and Nauman, who combined bring decades of experience from across various continents and markets. I won't say just how many decades it is in case it reveals more about the age of the panelists than they've agreed to share, but this should hopefully be a very insightful and interesting session because the panelists really come with a blend of regional expertise from North America, Europe, LatAm, the Middle East, Africa, and they really have significant experience in credit assessment and risk management. Between them, they've done various successes over the years across navigating financial landscapes through multiple economic cycles, Silicon Valley tech booms through to emerging market growth. And between them, they've held leadership positions at major FIs, including Deutsche Bank, Standard Chartered, Citibank, HSBC, and of course, Dun & Bradstreet. Plus, we are also fortunate to be joined by Dr. Arun Singh, who is our global chief economist here at Dun & Bradstreet. He comes with over 2 decades of experience based in the APAC region, so he will speak a bit on that. And really, my job is to bring together all of their real-world insights to help each of us understand today's complex bankruptcy patterns and really what they signal for business resilience over the coming year. So that's it in terms of an introduction. Some housekeeping rules. This will be recorded, so for those of you who want to listen to it again or want to pass it on to other colleagues, you'll have the chance to do so. There is a question box where you can leave questions and we will do our best to get answers. I'm going to make it very interactive. There'll be some polls, and the idea of that is to really get a sense from you guys what you consider the challenges, the focus areas, so that each of the panelists can do their best to make it as relevant to you. That really is all from me. What I'm going to do now is kick off this session with the first poll. So soon what will come on the screen is a chance for you to vote. I'm just going to make this go live. I'll give about 40 seconds for you guys to click and then close the poll, and then we'll kick off with the first speaker. So this should come onto your screens now. So the question is, what is the primary drivers of business insolvency in your market right now? So really it's to get a flavor of what you are seeing as the drivers, whether or not they are the actual case. There could be more than one answer. But of course, we will dive into some of the trends, but it'll be really good to just see how this split looks for the people on the call. Hopefully it's something that is expected by our panelists, but we are here to be surprised. Okay, so we have a bit of a split. I'll give it another few seconds. We now have the voting that has started showing some of the results, but there seems to be one that's taking the majority. Okay, I'm going to end the poll shortly, so hopefully most of you have had a chance to respond. I see things are still adjusting, that's why I'm giving it a few extra seconds. But what we do seem to see quite clearly is that inflationary pressure seems to be the one that seems to be the most primary driver. It'll be interesting to see afterwards what regions tend to get that. Interest rates the least, and then there seems to be an even split between political and supply chain disruption. So really it is inflationary pressures that seems to be what is the leading cause of this. And I want to start, I guess, Arun, with you here. Is this something that you are surprised to see, would have expected to see, and maybe how, in your experience, how these sort of bankruptcy patterns have been evolving in recent time. Is this something that you expected?
Thanks, Anand, for that question. I was expecting. I thought that this will come around, and in fact, all these factors, if you talk about, it's interlinked, right? And now, the moment your inflationary pressure goes up, ability of central bank to cut interest rate further drops down, and in case inflationary pressure continue to remain upward trajectory, we have a concern, and that might translate to elevated interest rate, that might translate to the stressed balance sheet, and things might go even further concern or bad for 2025 as a whole. So I think this was largely expected, and this is what I can see. I mean, basically, I talk about same thing, but I think not much surprised.
A good start, at least. So I think we'll stick with you. It'd be really interesting for you to share some of the findings that you have come across. I believe you have a slide to present to everyone. Let me know if I can bring that up for you, but I believe you'll be able to navigate this yourself. But yeah, really, let's get into it. But I think has some telling information about some of the key findings that you found over the last year, and the way you see the trends have evolved and are evolving. Should I bring this up for you?
Okay, great. So I can see slide, and I hope so everyone can see the slide. So as Anand was talking about, we are basically going to talk about global bankruptcy trends, what we see globally, and of course, later part of our discussion will possibly also see that what are things happening at a regional level and what we see going forward. And actually, it's a very exciting times, and in fact, it's interesting time, right? And the things started from 2019 onward, when we all see that there was some sign of green shoots were visible on the planet, and we thought that things will now normalize, things will now come into normal growth trajectory, and entire global economy will see some light other side of the tunnel. But unfortunately, starting 2020, yeah, we had pandemic, and that since then things never revived, things never improved. And during pandemic, all the governments, in fact, most of the government, if you can see, they rushed to support their economy. They provided some measures, some support to the local businesses in order to keep them afloat, in order to keep them surviving. So even in the small side businesses who had some trouble in terms of the balance sheet, they got support from the government, and that's how they survived. And 2020 was one thing. Then we had some second round, third round. Most of the countries have gone to the pandemic round. And when things started shaping up, then we had some conflict between Russia, Ukraine, and then followed by Israel, Iran, Hamas, and everything. The geopolitical concern continued to be in supply chain disruption. Basically, we never eased, and now we have a tariff-related problem. Right now, every day, last 6 months, we can see every day we have some sort of other concern in terms of coming up with a tariff, a geopolitical concern, or some other business-related issues. So that's now defining how each and every businesses are facing that heat or the pressure in order to keep them surviving, in order to keep them sustainable. And that's what basically we are going to talk about today. Moving on, some hard number, some hard data, and I believe all of you can see slide. Look at the data point. This chart basically indicate about the corporate insolvency. And unfortunately, and that's unfortunate data point to talk about that, this is highest in last 10 years. So if you talk about last 10-year data point since 2024, number of corporate insolvency in the global market, where we track the number of countries, where we track something around 45 to 50 countries we track on the planet, and these countries are commercially very important countries. So you assume that they have a good percentage share in terms of in describing the global bankruptcy. That's a 10-year high. And if you see, that was basically I was trying to talk about 2018, 2019, 2020, and 2021. If you see, you have a more or less flat number of corporate bankruptcy. The thing started deteriorating from 2022 onward, and 2023 had seen significant jump, and 2024 was one of the biggest jump we have seen to contribute, once in a 10-year high number. Now, the reason for that, if you see 2020 and 2021, we had a government support. And as a result of that, most of the countries, in fact, advanced countries, they face a very fiscal deficit crisis in those countries. The government debt and rest of the things have shot up so significantly. So that become very difficult for the government to keep supporting companies, and from 2022 onward, the government started withdrawing the support, and hence you can see those corporate bankruptcies started going up. And 2024, basically, it's one of the top bankruptcy number of bankruptcy we can see here. And that's a concerning number. That's a really concerning number. Certainly, when I see, I mean, I'll present a couple of slides later. You can see 2025 slide. 2025 doesn't look good either, and that's also a concern. So moving on to talk about where we see in terms of where we capture this bankruptcy coming from. So nearly 2 in 3 economies which we monitor, and through our own in channel or through our other channel, you can see that 48% of countries where we monitor reported some sort of a bankruptcy or business failures in 2024. In 2018 to 2019, that was pre-COVID era. Post-COVID, I think that's 2022 to 2023, that shot up to 61%. During COVID, you can see it's one of the lowest number. In fact, lowest number of countries reported some sort of a bankruptcy. But look at the post-COVID, that's a 61%. And now in 2024, 65%, we have seen the bankruptcy coming in, percentage of economies reporting in terms of the increase in the bankruptcy. So there's the bankruptcy we can tag in terms of 3 things. There are bankruptcy happening for sure in every countries, but some countries reported decline in bankruptcy rate. Some countries are almost same. Some countries have shown the increase in the bankruptcy rate. So you can 65% of those countries, almost 2 in 3 economies, what we track, shown the increase in the bankruptcy rate. So that's a concerning number coming from the market. Now, if I have to look at monthly data, or in fact weekly data, and this is a corporate bankruptcy coming in, and when we monitor this from the US, how the weekly bankruptcy filing happening. Look at this. There is basically no broad seasonality in the data. It's a very flat. You can see there are, of course, blips happening. It's a periodic in terms of which week, which fortnight they are basically reporting. But if you look at dotted line, this dark gray dotted line, that was 2022. It's one of the lowest number. It's down. 2023, you can see that was more than 2022 data. 2024 is more than 2023 data, and so the first 6 months of 2025 is more than 2024 data. So every week you can see, possibly if you can aggregate to the month data, every month bankruptcy reported is certainly higher than the same month reported last year. So I think there are very few weeks, I think very few months in last 3.5 year, you can see that bankruptcy rate remains same or decline. In fact, every month, every week is bankruptcy rate is basically surging. So first 6 months of 2025 is no exception. Bankruptcy rate continued to go up. So we need to be basically careful in monitoring those trend. Now, moving on to some of the another concerning phase, and which basically to your question, Anand, when you asked that what are the trend, what are the basically the concerning base or reasoning where why bankruptcy rate is basically going on, what basically driving your bankruptcy rate. Look at the global economic policy uncertainty rate. Uh, I mean, if you look at till 2020, 2012, 2013, the global economic policy uncertainty rate was, of course, it's a volatile, but it's almost flat. Look at it's, just maybe 100 or 200 index point. And from 2013, you can see started going up. It peaked during pandemic to some extent. I mean, if I take out 2024 and 25 data, so the earlier peak was somewhere in 2020 because of a pandemic. Of course, everything was shut, and we didn't know what to do when government was, jumped to support countries, companies, and economies, and they had lots of measures, but we had basically serious concern. But look at that. Today, the tariff and other geopolitical concern is all-time high. The global economic policy uncertainty index, if you see, is all-time high. Now, what else you need in terms of which the reasoning why bankruptcy rate is going up? Look at this data point. That itself is telling you that something is not right in the overall global economic framework. So, uncertainty index is all-time high in 2025, first few months, and of course, latest end of 2024. Now, another things, if you look at, we do the business survey of corporate. So 10,000 businesses we do survey of every quarter. So if you talk about how they feel 2025 Q3, that's starting from September, July, August, September quarter. Sorry, yeah. So if you look at that quarter, that everything, most of the parameter our businesses are telling us they have a lower optimism. In fact, they're trending towards the pessimistic scenario. In terms of the gross sale, there's a 17% decline in the optimism. In order to say the domestic orders, 15% decline in the optimism. Selling price, in fact, that things a 17% decline. 25% in the inventory level. In fact, domestic macroeconomic environment is you have a 10% decline. That's a problem. And when it asks them about the new trade distorting policy measures, you can see the contribution happening from the advanced economy. So the trade policy taken in the advanced economy, they contribute to significantly in terms of overall economy distorting trade. So these are things coming from the horse's mouth. These are things coming from the companies who are operating on the ground. They feel things are not happening good. So that's how it's reflecting on their overall optimism and overall bankruptcy trend. Now moving on, this is another things, and this is exactly you guys have shown in terms of inflationary expectation. If you look at inflationary expectation in the US and then Euro area, this all because of tariff and tariff related concern. Look at the surge in the inflationary pressure in the US, and this is just the inflationary expectation. And historical evidence suggests an economic policy, economic model will basically tell you that inflationary expectation always moves ahead of the actual inflation. So if inflationary expectation is higher, and that's look at this is one of the highest number in a recent month or year for the US, that's something is seriously wrong in overall economic framework, and that's certainly going to take a toll in terms of cutting interest rate going ahead, because this means that not just the US, also in the euro area, the central bank whether talk about the Fed or talk about the Euro Bank, or you talk about the Bank of England, you talk about any other central bank, have a tough time to even cut interest rate. So there could be possibility they might reverse interest rate trend and maybe start increasing interest rate if this tariff things does not take a shape, if this tariff things does not come onto the more of a control scenario. So that's a problem coming from the inflationary expectation. That's what I was saying, that I'm not surprised when you talk about inflation is going to be a serious concern going forward. Now,
I,
moving
w-
on,
I
if
wanted
you
to
look at
actually mention something there, just give a chance for some of the other panelists to come in, because I think it's really interesting that you've framed and shown that at an all-time high, bankruptcy rates and also optimism is declining. But interestingly, on that previous slide, we saw that there's quite a distinguishment between the euro area and the US in that sense, when you're looking at the inflationary expectations ahead and what that serves. And on that, we have Sergio here, who I'm hoping, coming from the Americas side of the world, a question that I had for you is, taking this macro concept, but maybe relating it to some of those areas. Like, what do you see as some of the fundamental shifts that I guess are happening with how businesses are responding to the different types of financial distress, some of the ones that Dr. Arun has spoken about? And, are they adjusting risk mitigation strategies to go along with some of these shifts? I think you're on mute.
Yes, I'm sorry. Can you hear me now?
Yes.
Yes. Okay. Yeah, I had a little bit of connectivity issues here this morning. I apologize for that. So, yes, I think you summarized it well with the mix of, optimism, not in a good, optimism fading, and bankruptcies increasing. There's no doubt that the business cycle, the business risk situation in Latin America has increased significantly more recently as a result of uh, the local economic situation in every country, characterized nearly in every country by high political uncertainty and fiscal pressures, and the geopolitical factors, very importantly, all the disruption of trade patterns in the world as a result of these tariffs and the expectation of inflation that will come with it. So, businesses in Latin America are no strange to tough economic cycles. I think companies in Latin America through history that have been resilient, generally speaking, they have tended to pursue a prudent stance to growth, low risk, low cost structures, and low financial leverage, and that has accounted a lot for the resilience of companies in Latin America. So I think this time around is pretty much the same thing. Where I see a fundamental shift is in how quickly companies are adapting, and how agile they can be to adapt to a new situation and change, switching from reactive to proactive change in their strategies, their cost structures, and efficiency. I believe technological innovation is driving a lot of that. As a result of the COVID crisis, companies learn a lot about how to leverage technology for more efficient collaboration, to keep better trade relationships, and to keep their business models going. More recently, that has been even increased by the change of artificial intelligence, dramatic increase in the way companies can operate on many fronts. So where I see the difference today is business in Mexico and in Latin America more proactive because they're pursuing risk mitigation strategies for upcoming. Such strategies including diversifying the cost basis, supply chain risk, better managing the trade credit risk, and manage their cash flow. So, as an example, what I will tell you is in our own business, these last few years, certainly this year has been one of the stagnant growth, and one where companies care a lot. And even at a time like that, where companies are rapidly pursuing cost-efficient strategies, we see our own business information, business growth in double digits. And the reason for that, I believe, is because companies understand the value of active risk management. Companies understand the value of acting early and making data-driven decisions, supporting their business and executing strategies with current data in our world that we verify. So I think that's the difference.
Thanks, Sergio. I don't know if there's a sound issue on your side, so I think just worth checking that. But I think we caught the most of it. Malin, I wanted to come to you next, so hopefully some of his points were still quite clear. I think it's not surprising, but interesting to see that there are systemic challenges that affect the general global picture, and compared to different points in history, they really are in some areas, especially coming all at the same time. It's no surprise they're kind of what Arun showed, they're at an all-time high. But I guess there are also regional specific differences, and coming from your expertise more in the Euro area and the time you spent in Sweden, etc. Do you see similar shifts happening in the way that businesses are responding to distress here? Are the distresses similar, and how do you see in your experience that in the Euro area, especially, they're adjusting to their strategies to compensate?
Thank you. I hope you can hear me clearly. Can you confirm that you can hear me?
Yes.
Okay, very good. Yes, so there are obviously similarities in the global arena that we work in, and maybe a little bit more specific also. So, but I think you said everything comes at once, right? I believe that Europe is basically in its perfect storm almost, and the consistency of constant change is permanent for all of us. I think that is a fair point to make. And it's hard to kind of single out things because there are so many layers in a very complex situation. But we definitely see fundamental shifts in how business across Europe are responding to financial distress. And I will kind of highlight some of them. And these changes reflect both the lessons learned from recent crises, like COVID or the energy shock that kind of took us almost by surprise, and the evolving financial landscape, right? So we see some business having structural challenges where many businesses are facing long-term issues as a digital transformation, delays, labor shortages, and supply chain disruption. But there are also some mitigation strategies, and I will highlight 3 of them here that we have seen on a very high level, and obviously can change from country to country. But if you look at the overall one is something we talk about a lot, I think, throughout this call, is shifting towards more proactive restructuring. So there is a need and also a necessity for companies to intervene earlier in order to make sure that you take the right decision at the right time, because things are moving really, really fast. So you have to have like early warning systems or scenario planning and cash flow forecasting to detect vulnerabilities. So that kind of shift, obviously, as a company, you always say you're proactive and you have all of these measures, but we have seen a completely different ask for both more data in order to kind of predict things and also to take the right decisions. One other thing that is based on a data-driven kind of thing, but based on technology, digitalization, and AI-driven analytics. Because what we see also is that the use of AI analytics to identify inefficiency and optimize working capital is a necessity, since there is less growth, there is less money in the system. So you really have to be efficient. You have to have a cost optimization program. And it's really important, I think, for all companies, and I'm a little bit of an AI and data nerd around this, but to understand and start using AI in order to be part of the race being efficient and agile. And we can also see that the companies that starting using it and actually show results will be much more faster moving than other companies. And also, we have been talking about digital transformation and cost efficiency and all of those things, but in order to make fast, but that seems to be increasing now also, because in order to enter a new market or shifting different financial models, you have to be digital and you have to have that kind of transformation and cost efficiency. And the last point, the third point, is sounds obvious, but collaboration and transparency. And there is a stronger emphasis on collaborative restructuring involving creditors, suppliers, and employees in order to be transparent and communicate the strategies are now seen as some sort of a critical maintaining trust during these very strained times. And if I have time, I will want to just one other thing that I really want to kind of highlight that we see as a, I wouldn't say trend because it's a little bit of alarming, but we see in connection to bankruptcy, we see a lot of fraud, financial fraud increasing in our area. And there is a rising concern from companies than before. Before, the mitigation of risk was obviously high up to make sure that you have a risk capital of okay, you're willing to take a risk here and there. Now we see companies seeing that the risk of people not being able to pay is one thing. The risk of people not even having intention to pay is another. And I will give you an example that I thought I was a little bit mind-boggled by it. The Swedish Economic Crime Authority, an agency here in Sweden, has estimated that the criminal economy in Sweden is valued around 10 to 16 billion US dollars. Here in Sweden. That means that the fraudsters are advanced company people, actually having very complex company structure, is very familiar with the rules and regulation in companies and how to build companies. So here there's an increasing trend of having warning signals in order to pick up changes, and it goes really fast. So that has been a pretty big link together with the bankruptcy in the Northern Europe and in some other markets as well.
Yeah, it's really interesting how digital presents a more double-edged sword there, right? There's so much opportunities for growth and efficiencies and optimization, but with that, obviously, you present the challenges of everything that is leading to around cybersecurity and risk. Very quickly, is there a specific use case or example that you know of that really demonstrates some of the things you've been talking about, where these risk mitigation strategies have either been put into place and seem to be having an effect, or set a good example of best practice?
I mean, I think one when it comes to fraud, then because I think it's an interesting topic. We have one client that is in the cross-border here. It's called Skanska. They rent equipments and machinery, and they had problems with fraud, and that took both time, and they weren't really efficient, and they couldn't really do things, and actually they got a lot of risk on their portfolio because the fraud actually increased in their phone. So they actually managed then to have analytics capabilities to make sure that they could highlight that in the report and actually say no to people then, which meant that they could actually remove that kind of risk and become much more faster in onboarding the real clients also, because that was also one of the problems. It took a long time for them to detect it. So I think with the right analytic capability, the right data, and also with the right warning signals, this could be detected. And that was a perfect example of things, because these companies went bankrupt in the end, so they lost the money.
Yeah, that is fascinating. It'll be great to expand on that further. And I'm sure if there's anyone on the call that wants to know, you'll be happy to have them reach
yes,
out.
we'll be very happy. Yes.
That'd be great. Yeah, Nauman, so you get the fortunes of going last, which means I'm sure there are some things that have already been said that you may have said yourself. But I think the GCC and wider Middle East is a really interesting space because it has, along with the global picture that has become emerged in, it does have its own regional tensions. And I don't know if it's fair to say, but reputationally, it's been regarded as a very cash-rich and fast-moving market, especially in the last decade or so, with the economic development and its expansion globally. How has that shifted, and how have those sort of regional specifics really played a role in how things are evolving in that space?
Of course. So thank you, Anand. Yes, never easy to be last or the first in any way. But it's always a pleasure to have this kind of a conversation. So good morning, good afternoon, and good evening to anyone on the call and hearing us today and even the recording. So from a Middle East or a GCC perspective, Anand, I think I have to start by saying two key things. So one is that we are witnessing a very fascinating interplay of, let's say, global uncertainties towards regional transformation agendas, right? And we've heard from Dr. Arun at the beginning, and we just, while global headwinds are there, surely, right? 2025 seems challenging, and there are various challenges that are there in the market, but the proactive strategies and the inherent strengths you just referred to within the GCC economies are shaping the unique narrative. So one key theme, and the second point here being that one key theme that seems common across a lot of markets is a pivot from scale to substance, right? And that recalibration should not be looked at as a retreat of the overspend or the major spends that are happening, but rather it's a signals to a transition that we can describe as, let's say, precision finance, right? Which uses strategic levers and tweaks here and there, such as, let's say, issuing commercial paper or asset recycling or co-investments and sovereign partnerships. And that is all what is going towards preserving liquidity and reducing the financial strain, as you would call it, based on this aggressive thing. So if we move away from these two common themes and overarching ones, specifically what we do see in GCC and the wider Middle East is it's going from more reactive to a more proactive, preparedness for what's to come. And historically, we've seen, as of any economy, that you react to distress, and which has been the case here as well. But we can see a recent political uncertainties, such as, let's say, the disruptions in the Red Sea or the regional tensions, have pushed businesses to adopt more proactive and more scenario-based financial planning. And they're not just managing crises, but anticipating and building buffers to manage them, right? So that goes into also the second point within this key area, such as enhancing focus on, let's say, liquidity or cash flows. And that's what I alert to right at the beginning, that there's just not, so there we can see a fundamental shift in the heightened obsession with cash flow optimization and liquidity management. And businesses are scrutinizing receivables, payables more aggressively, negotiating contracts and terms, which is then feeding into the third point, which is, let's say, digital transformation, right? As that surviving tool in the, let's say, the pandemic first, first accelerated the adoption. We heard Dr. Arun there as well, that it helped accelerate that digital adoption. But the geopolitical and economic uncertainties around have cemented it. And this is now the future, right? Where businesses are heavily investing in digitization for not just efficiency, but real-time visibility and cost reduction as well, and which we feel is directly aiding to managing this distress that might arise, right? So probably we can't, and something that you alluded to in your opening part, that so the leveraging the government support and reforms, the GCC governments have been agile, right, in providing economic stimuli and subsidies and regulatory reforms such as bankruptcy laws or ease of doing business. And businesses are becoming more adept to understanding and leveraging these support mechanisms to navigate these periods of small financial strains that may come because of some economic cycle. So maybe I'll hand it over back to you if that goes into the narrative of what we're trying to build in, and to the wider Middle Eastern economies at large.
Yeah, it's let's. I want to dig a bit deeper, and then I think we'll leave time at the end for some of the questions that will really focus in on that. Because we've spoken a lot, starting with the sort of optimism and how that's looking, and the number of factors that are now playing into leading to increased bankruptcy filings and all of that. But to tie in or to leverage onto some of your more industry specific expertise, it'll be interesting to know if there are cases where you've seen different sectors performing differently, and especially where they've showed resilience in this space, because I think where there's opportunities, there's chances for growth, right? When there's challenge, it presents some opportunities for some of the sectors to do better if they're well set up. And again, I think speaking to the panel, Malin, I think let's start with you for this one. But where do you see that some of the sectors have performed differently, and especially where they've showed resilience, and what may be driving that resilience?
Difficult question. But if I have some examples from the European part of it, I would say that some of the sectors that have shown resilience and growing is that we do have examples both in the bank and finance services, especially the bigger banks across EU. They both have strong capital and liquidity, and profitability actually remains pretty high. Although their risk would probably be more from a geopolitical tension, and cyber threats are basically rising on their side. The other one that we have seen resilience is that the manufacturing actually has kind of rebounded strongly after COVID and absorbed some of the things that has happened in Ukraine and inflation. So that's pretty good. And the reason for that on a high level is basically a really good operational excellence and adaptability of the differentiators. So they have been really good at that one. Another sector, maybe driven by other things, but is health tech and biotech, both from a post-pandemic kind of innovation perspective and an aging population in Europe. So there's been a lot of investments in both health platforms and biopharma and medicine and all of those things. So those three sectors have been quite good at the resilience part of the currently.
Sergio, is that something similar that you see in your space as well?
Yes, for the most part. I think definitely the financial sector is holding well. There is a good example of prudent risk management by definition. So banks are well capitalized in Mexico. They continue to provide credit, and the performance, the level of non-performing loans in nearly every sector of the economy is in good shape. So that's also a mechanism for resilience in the entire economy. I believe also, manufacturing, logistics, which are key industries in Mexico, and particularly manufacturing export-oriented industries like automobiles and other parts, have also shown resistance despite all the expectations of the impact associated with the tariffs and the changing trade patterns. I believe the reason for that is that the Mexican economy is so closely intertwined with the U.S. in supply chains. And just more recently, there has been actually an increase in export activity in anticipation for the upcoming tariffs as companies try to build inventory in better cost. But I think longer term, manufacturing and the ties to the U.S. economy will continue to be resilient and will continue to be a very important element in the economy. These are being hit the hardest is anything that depends on investment. There's been a very steep decline in public and private investment in generally speaking in Latin America and certainly in Mexico as a result of this uncertainty. and volatility, companies don't see this as a good time to make heavy investments, big decisions, and governments have a lot of fiscal pressure and high deficits. So yes, we've seen a contraction from that perspective on infrastructure, on construction, on anything that depends on heavy investment. Last, consumer spending, services, retail, that still shows resiliency. I think that has a lot to do with the general sentiment and demographics, but most likely that's going to change as companies start laying off employees, unemployment rises, and the country and the region enters in economic slowdown and recession territory, unfortunately. So overall, financial services, manufacturing, holding up well.
Yeah, so some definite similarities I heard there, right, with manufacturing, despite the impact of tariffs, I guess, which could be a surprise to some people. But then to really see the ones under pressure being the likes of construction, infrastructure, real estate. Again, Nauman, to finish with you on this one, but do you see that also being something similar that you've witnessed on your side?
Sure. So I think from a resilience perspective, I would say energy or the wider oil, gas, and renewables, while historically they've been volatile, the oil and gas sector continues to remain that backbone, right? And these recent energy prices, which have gone higher and lower, have provided that significant physical buffers for the governments, which have logically a trickle-down effect to the private sector as well. But crucially, the massive investments in renewable energy and, let's say, green hydrogen in, let's say, the UAE and Saudi Arabia are driving that growth and long-term resilience, creating those new value chains which are required for that economic stimulus as well. But from sectors which are seeing pressure, I would say they probably be real estate or commercial. So while these mega projects drive that segment of construction, the broader real estate market can be cyclical, right? And sensitive to the global interest rates. So however the population is growing, the government housing initiatives are there, are providing that, let's say, that underlying demand for this to grow. But if we look at from a Middle Eastern perspective, the overarching drivers of this resilience, I would say there are four of them in general, right? So one, it has to be the government spending and the giga projects that are there. So it's not mega, it's giga, it's like a step above, right? So the unparalleled public investments, especially let's say in Saudi Arabia, it acts as that primary economic engine. It creates the demand, the jobs, the investment opportunities across various sectors of the economy. The second thing that we can look at is economic diversification agendas, right? So the national visions of the various GCC economies are actively reducing that oil dependency and fostering non-oil GDP growth as well, and creating the entirely new industries which were not fueling the GDP growth historically. Third is, of course, very strong sovereign wealth funds, right? The sovereign wealth funds are providing a financial cushion and that ability to make those strategic investments, support industries, and even being national champions within these challenging times whenever they do come in. And the last, which works really in the favor, is that young and that growing population that contributes to the retail side and technology and all the others as being that robust consumer spending and dynamic workforce that is there. So while there are similarities, but I think there are distinct GCC-based, I say wider Middle Eastern-based nuances which are unique to the region as well.
Yeah, I think that's something to highlight here. It's one of the reasons that it's so useful to have you guys on the call from the different markets and also different sectors, especially from the point of view of people in attendance. It's that, especially when you are doing business, not just in your own markets, because it's interesting to see what you guys think, when it comes to the Middle East or when it comes to LatAm or even on the sector side. But I think, especially as the world becomes smaller and, whether it's your supply chain or any other kind of cross-border business, there is a likelihood that you'll be doing it on a global scale, whether it is through your tier 1 supplier or tier N. And so I think it does become very useful to understand, well, yes, there is a global picture on how things look in terms of bankruptcy and even resilience, but then it is really useful to understand what is happening in the different regions so that you can better understand the risks that you do face and what the outlook looks based on what your portfolio is. So thank you for sharing that. What I want to do is switch back to another poll before I do go to my next question for you guys, because I think it'll be interesting to get a sense on this next one, specifically for the audience to find out what the challenges and focus areas that they're facing when it comes to risks and what they're looking to mitigate on in this year. So I'm going to bring up the poll again. I'll give you roughly a similar amount of time to answer this one as well. And the question is, as I said, what type of risk is your organization most focused on mitigating this year? It'd be interesting to know what that is. I'll give it at least another 40 seconds, but I will end it quite sharply to really leave time for everyone here to be able to speak on some closing remarks and hopefully leave time for some questions as well. Okay, a very clear winner, but especially given some of the things that was spoken about, it's interesting to see what still isn't as much of a focus. Okay, I'll give it another 10 seconds and then I will ask the panel to maybe draw on some of the things that this shows. Yes. So again, yeah, back to everyone, kind of to close off and really to keep it to kind of that, that major takeaway that you want people to get. Firstly, very quickly, is this poll something that has surprised you in what it says, or something that you still understand why that is the case this year? And then really, I guess, if you could close off by giving that one thing that you want the audience to take away from today, whether it is an action or a learning or something that you think will be valuable for them to spend some time understanding or looking into. And this time, Nauman, you'll get the fortunes of, I will start with you.
Of course. Thank you for that. And so if you look at the poll results, it's a bit surprising for me. I would have bet my money on people saying supply chain disruption being probably a higher one to mitigate as compared to credit risk, which probably scored the highest. I'm assuming all the panelists or the audience can see the results as well. So it's just a bit surprising for me, Anand, I'll be honest. And but yes, we do see conversations around both credit and supply chain across the Middle Eastern markets and wider Africa and Asia as well. So that's what my vote would have been on, supply chain. But in terms of some closing remarks, so I don't think I need 60 seconds, maybe just a few seconds here. That from a Middle Eastern or a GCC perspective, the true business resilience in, I would say, 2025 and beyond is not just about weathering a storm, right? It's about actively building future strength. This means embracing proactive, data-driven strategies for both risk management, relentlessly pursuing for economic diversifications, and leveraging technology to transform, I would say, all the challenges into real business opportunities. Right. So yeah, thank you for having me and thank you for listening. But yeah, that's how I would like to conclude it.
Thanks, Nauman. And Sergio?
Sorry, I was trying to unmute myself. So, not surprised to see credit risk as a top concern and a top area of focus on mitigating risk. These are difficult times, and I guess my take is, we will continue to see volatility, and we'll continue to see very difficult business conditions throughout Latin America, and certainly Mexico, with the economy more exposed to the global geopolitical trends, aside from our own internal challenges. So one of the characteristics of the region, I believe I mentioned earlier, is low financial leverage, which is a good thing when you think of bankruptcies and insolvency. But it's a very difficult thing when you think of trade and continued operation. A very large amount of the financing that companies obtain in the way they finance their working capital relies on supplier financing. So when you look from the supplier perspective in the business-to-business relationship, a cycle like we're currently living means increased credit risk, increased demands for trade terms from their clients, and therefore that has to be managed very carefully. This is a time where companies have to be very focused on liquidity, on cash flow. Probably not a time to take on a lot of leverage or making big investments, but rather to keep the operation going. And from that perspective, my message to the audience that has been kind enough to be with us today, that this is a time to focus on the fundamentals and, like it has been said before, proactive risk management. A lot of discipline in managing credit risk, in making data-driven decisions and monitoring, both on your trade credit portfolio and also on the supplier side. This is the same thing. Ultimately, a company that faces constraints on supplier side will hurt on cash flow and conversion. So proactive risk management, I think that's the key. Back to basics, a lot of discipline in managing clients and suppliers. Thank you very much for having me here today.
Yeah, thank you so much. Proactivity is definitely one of the key areas that came up, and that can mean different things to different people. So I think it was really good to hear what you really see proactivity meaning as something that the people can take away and actually action as in the short term to have the maximum efficiency. Because I think it's no longer a case that proactivity is what's needed for growth. It's almost what's needed for survival. Like in many cases, acting now is going to be important. There are a number of questions that have come in, but I know we only have 1 minute. So what I'm going to do is take these questions offline and share the ones that are specific. I think you see, Malin, that's one that's come through just for you. So I will make sure this question gets to you, and you can spend more time going into an answer to the person who asked it. But hopefully, if you guys don't mind, what I'll do is share the questions with each of you and who has provided that question. And then if you are happy to provide your answers in a form of an email, I can make sure that the answers get to them, if you're happy to do so. Great. Nodding approvals. Thank you everyone for sticking with us over the last hour. And I really hope that some of the content was useful. I hope that my questions were the right questions to make it useful. But again, any other questions that come in, feel free to reach out to us through the contact that informed you about this webinar, and we'll make sure to get the answers for you as quickly as we can. Thanks again, and thanks for your contribution in the poll. I really hope that you enjoy the rest of your morning, afternoon, or evening.
Thank you. Take care. Have a good day.
Thank you.
Thanks, everyone.